Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. And this week we're dissecting trading tactics to consider as we wrap up 2019 and head into 2020. New York Life Investments is here to discuss the major themes set to impact the market's direction in the coming year and what you could do now to position your investments accordingly. We'll also analyze one of this year's biggest winners, a software stock that's doubled in price. I'll share why it could still have more room to run. And NorthCoast Asset Management will provide a look at ETF portfolio strategies for tactical growth investors and those looking to get tactical from an income perspective. Investing Strategies starts now. Well, let's kick things off with this week's market insights. Here now to dissect stock market themes to watch in 2020 and how to position your portfolio for the new year is Lauren Goodwin. She's an economist and multi-asset portfolio strategist with New York Life Investments. Thanks so much for joining me today, Lauren.
Thank you for having me.
All right, so when we take a step back and look at the latest round of economic data, the market seems to like the latest jobs report, but what's your take on where we are with the economic data as we're still near all-time highs?
Absolutely. Well, if you think about economic data as it comes in, so week by week, month by month, the signal can be pretty confusing. We have the manufacturing sector and corporate profits looking weaker, and the consumer sector doing really, really well. For us, it's all about putting that economic data in sequence. And so if you look at the way an economic cycle normally transgresses, we would expect the consumer sector to be the last domino in the round to topple. So it's great news that the consumer still doing well. It's 2/3 of the US economy, but it is the thing that tends to turn last. And so the fact that earlier dominoes, again, manufacturing, corporate profits, have already weakened, tells us that risks are skewed to the downside.
Well, let's talk a little bit more about the corporate profits. If you could break that down just a little bit more for us, why is that a concern for you heading into the new year?
Well, if you think about it, if a company is making money, then they don't have to be quite as worried about risks, things like trade wars or really anything that would happen in their supply chains or in their business. When those profit margins are decelerating, for example, or looking weaker, then companies are more susceptible to risks in the economy. And so when we look to 2020, seeing those corporate profits looking weak is something that we're really concerned about when it comes to asset valuations.
So for the corporate profits, we're seeing downward revisions, but still positive growth year over year?
That's right. That's right. So downward revisions, not just in earnings that we're seeing with companies, but also in economic profits. That takes some of the potential manipulations or changes that companies can make in their accounting. And that's really where we see the potential risk, that vulnerability to economic shock.
And then the big overhang for that is that the trade war primarily, or what else is in the recipe for that?
Well, if there's one thing that's certain about 2020 is that we'll have tons of headlines. But yes, when we think about risks, it's what can really impact your portfolio for 6 to 12 months. There will be lots of things that are maybe shorter term, lots of things that you can't really control. Trade war is one of those impacts that we see having a meaningful impact on consumer portfolios because the tariffs that are in place and the ones that we could get in December 15th are meaningful. Those have a real impact on the economy.
So this year we've seen really strong gains for the stock market, but of course January also coincided with the beginning of a new uptrend after some pretty severe declines. So when we take a step back and we're looking at where we sit now, we're kind of coming out of a longer consolidation for the S&P 500, and over the last decade there have been several other periods with big moves to the upside after consolidations. Could we be at the start of a next big higher, even though there might be some questionable economic data points?
Well, certainly there are some countervailing forces at work here. So on the positive side for equity markets, lower interest rates have a really positive impact on valuations. For one thing, it means that companies can borrow, their costs are lower, but it also impacts valuations just on their own. And we see about 95% of the uptick in this year's equity markets as being due to those lower interest rates. Those are here to stay. And so that's good news for the equity markets. But again, where you have those potential shocks are in corporate profits. And so what we're thinking from an investment or a portfolio positioning perspective is taking that economic piece and saying, for most investors, it's probably worthwhile to move the core of your portfolio more defensive. So listen to the economic data. But you have to be ready to accept that lower interest rates and some of these moves in sentiment, things around risk like trade, could impact markets in the short term. And so we're flexible for those short-term opportunities as well.
So then when we're talking about getting tactical with those short-term moves, what areas of the market are you looking at?
We're looking at, for those tactical moves, cyclical sectors. So things that tend to do well when the economy does well. That can be things like financial services, consumer discretionary, small caps, emerging markets equity. The challenge there, though, for many investors is that we really are talking tactically. And so some of the uptrend that we've seen in the last few weeks, for example, might not last more than a few weeks. And so for many investors, it makes sense, again, to be more defensive as a whole. But if you do have the risk appetite to move more quickly, that's where we're focusing.
All right. Well, a very interesting discussion as we wrap up the year and head into 2020. Lauren Goodwood, thanks so much for being here.
Thanks for having me.
All right. And coming up after the break, we're taking a look at a growth stock that's been one of this year's biggest winners. Back in a minute.
Leaderboard helps you invest better with winning stocks picked by our team of experts. Select a stock to see current analysis. Check the chart for buy and sell points, plus get real-time price alerts. Improve your investing with Leaderboard. Start your free trial today.
As investors prepare their portfolios for a new year, it's important to take a look back and study the stocks that made the biggest moves. That way you can analyze when would have been the best time to buy and the best time to sell. That kind of post-analysis is invaluable when it comes to improving your trading skills, so you can keep an eye out for what will be the next big winners in the year to come. E-commerce software leader Shopify has no doubt been a top-performing growth stock this year, more than doubling since a breakout in February. So let's take a closer look at this first setup for the stock that sparked the breakout. Now, this 6-month-long consolidation was the first real pause for the stock since it moved from 45 to 175 over an 18-month period. Now, when you see a consolidation like this, it can provide enough of a reset after a big move to create a new setup for another big move. And during the correction of Q4 2018, that's what we're showing here, Shopify's relative strength line was hitting new highs. And that relative strength line measures price performance versus the S&P 500. And it was hitting new highs before the stock was hitting new price highs. That's very bullish to see, and it signaled to us that this stock had the potential to be a big winner once a new uptrend occurred. The market began rallying in January, and by February, we were seeing a lot of breakouts for top growth stocks, including Shopify. Now, this breakout was boosted by a quarterly report that showed earnings growth of 73% and revenue growth of 54%. That's well above the 25% growth that we ideally like to see for top growth stocks. And from there, pivoting back to a weekly chart here, Shopify staged a picture-perfect run over the next 6 months, finding support at its 10-week moving average along the way. Now, support like this along a stock's run is another bullish quality that we like to see, and it also provides investors the opportunity to add shares to their positions, or for aggressive investors, the chance to initiate a position. And this run was also accompanied by strengthening fundamentals, with earnings growth showing massive acceleration over the next 2 quarters. And by late August, the stock had run up from 177 all the way up to 409, and it had become well extended from this 10-week line here. Now, shortly thereafter, the software sector was selling off, and Shopify shares broke below their 10-week moving average for the first time since this February breakout, and the drop came in heavy volume. That marked a clear sell signal for investors. Now, at this point, some investors may choose to exit their positions, while others may opt to take only part of their position off the table. Either way, this move signaled the stock was ready for another break and needed to consolidate for a while. Now, if we take a look at the current daily chart, we can see how Shopify was able to find support at its 200-day line. That's this gray line here. And it's a key test for the stock, and yet another positive signal, as many former leaders this year were unable to hold above their 200-day lines when the market hit turbulence in August and into the fall. Still, it was important for investors to remain patient and wait for a proper buying opportunity to get back into this stock. And that opportunity presented itself just recently, with shares climbing above a 349.54 buy point from a double bottom entry. Now, investors would want to make sure they're not chasing the stock here and only buy if it's within 5% of the pivot point. Now, another buying opportunity could potentially present itself if Shopify forms a handle on its way to approaching those prior highs. Now, since Shopify had such a massive move in 2019, some investors might question whether the stock still has room to run, especially with a bit of fundamental weakness now presenting itself here. Earnings are taking a hit in the short term, but that's because the company is diversifying its business model. It's expanding beyond e-commerce software and into fulfillment centers for its merchants, directly taking on Amazon. And COO Harley Finkelstein says the company still expects to turn in the same level of revenue growth during that process. And taking a look at 2020 for Shopify, analysts expect annual earnings growth to surge 384%. That signals the growth story for Shopify is far from over, meaning the stock could have a lot more room to run. Okay, so when we come back, we're taking a look at ETF portfolio strategies for 2020. We'll be right back.
On Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3 AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
All right, welcome back, everyone. Joining us to discuss portfolio strategies for 2020 from an ETF perspective is Dan Kraninger. He's president and CEO of NorthCoast Asset Management. Thanks for being here, Dan.
Thank you. Thanks for having me.
So when we're talking about portfolio strategies for 2020 from an ETF perspective, I mean, what a year it's been this year.
Fantastic.
Big gains, but a lot of bumps along the way, providing the case and the need for investors really to be tactical with their positions.
Yeah, we think so. I mean, we think there's two big problems for investors today. One is, how do I drive income into account? Short yields are 1.6, long yields are 2.3, but how do I get a monthly check, especially if I'm using my portfolio to generate that income? How do I do that? We have a solution for that we call tactical income. And then if you're trying to grow your capital still, how do you grow your capital and be cautious about potential bear market risks? Those are the two big things we try to solve for with ETFs.
Right, so you have ETF portfolios then. How do you go about constructing those?
Well, that's an important question. I mean, for growth, I'll start there on tactical growth. The first thing we do is we consider the market risk. And for us, the market risk falls into 4 dimensions. We care about technicals. It's an auction market. Are people buying? We care about valuation, how much you're spending for that. We care about the macro economy. How good is it? How productivity, jobs, things like that. And then we care about sentiment. Are people optimistic about the future? And we measure those indicators, and that gives us a view on whether we think the market is a good place to invest right now. Right now, for us, we're about 30% hedged. So we're about 70% long, about 30% hedged. Once we decide that, then we move into security selection. What do you want to buy? And for that, again, we build models. We kind of sit at the intersection of art and science, where we take things we believe in and things that we think about the markets, and then we test them. Doesn't matter that an ETF is closing at a premium to its NAV. Doesn't matter that an ETF is gaining flows. Well, we take those concepts and then we test them and test them and test them with data and a lot of computer coding, and to build our selection process that's based on a risk-reward curve. Does it make sense to go into that ETF right now, given those ingredients? So that's our growth approach. Then on the income approach, we kind of do the same thing, but we spend a lot more time trying to measure the reliability of that, let's call it the interest payment and the income check coming through. So, two different approaches, one with an approach where we take a lot of concern about the market risk, and the other one really about the reliability of that income stream for the people that are trying to take a step up from cash or a step up from that first couple bonds they might have bought.
Right. So for the tactical growth portfolio, let's talk a little bit about the hedging strategy, because again, this has been a strong bull market, but a lot of bumps along the way. So a lot of opportunities to get tactical in the portfolio.
Yeah, I think so. I mean, our tactical roots go back 25 years. We've been doing this for a long time. And for us, it's a very important part of the process. People get really worked up over 5 and 10% corrections, but they really don't matter. They happen every year. They last about 8 or 10 months until you're back whole, and then you have to move on to the next thing. For us, all that matters is bear markets. And the good thing is that bear markets have common threads: rising inflation, slowing economy, things are kind of expensive from a valuation standpoint, and then prices break. If you're willing to pay attention to those 4 things, you can avoid a lot of the pain of 2008 and 2000 and 2002. We were in business, and we've done that, which is good, by paying attention to these things. So right now for us with our tactical growth, if you think about the dimensions we care about, technicals are really strong. Okay, that's great. Let's take a little investment. Sentiment is kind of neutral. A lot of the optimism is starting to wane a little bit. I think the tariff war is playing an impact there. Valuation, things are a touch expensive. Right? And the macroeconomy is pretty good. So you put that blend together. For us, that blend means a touch of being cautious right now, 30% hedged. And that's okay, because people who in our tactical growth portfolio want to grow their capital, they just don't want to take the big risk that comes with a big market drawdown. So that's how we handle that.
Right. So important to take a step back when we see all these little bumps. But when you're building an ETF portfolio like this one, what are the benchmarks that you're using to benchmark performance against? Okay,
great. So with tactical growth, that growth portfolio, we care a lot about the tactical competition out there. And Morningstar has a good tactical allocation category. These are all people that are trying to adjust to market conditions along the way. So we measure ourselves really against that, because that's our competitive group. But the other things we look at is the equity. What's the global equity market doing? What's the S&P market doing? So we pay attention to the equity markets as a fully invested construct, but it's more fair to compare ourselves to guys who are trying to deliver a more, let's say, smoother ride along the way. So that's that Morningstar tactical category average. On the income side, we compare a lot to global bonds and US bonds. We think the choices are for investors. You could stay in cash and earn 1 to 1.5 right now. You could take a little step up and you can earn maybe 2, 2.5 from some corporates or some governments. Our tactical income right now is yielding 4.2%, which is something that's double what you're kind of getting in other parts of the bond market right now. But to do that, you've got to do that with other securities. You've got to look at emerging market debt. You've got to look at mortgage-backed bonds. You've got to look at inflation hedge securities. And the great thing about the ETF world is it's so vast, and so the opportunity to get very specific on a particular risk is really great right now.
So speaking of emerging markets, what ETF or ETFs are you looking at in that space for one or some of these portfolios?
You bet. For tactical income, we own about a 10% position in EMB. EMB is just a broad ETF that collects a lot of emerging market debt. I think it's 30 countries are represented inside that ETF. The great thing about it from our perspective is the yield is 5.4%. The duration is about 7. That's really good. That's kind of double what you're getting in the US plus right now. And for us, the risks in emerging market are kind of waning a little bit. The macro economies are doing better. The bonds are relatively cheap compared to other bonds around the world. So for us, again, this solution, tactical income, is different. It's solving a 2019 need versus what maybe people looked at income 20 years ago. You're going to have to use a current solution and a current approach to an income problem nowadays for people. If you're trying to get 4 or 5 or 6% in income, you're going to have to look to securities that don't necessarily feel normal to you. And EMB is one of those that we recommend. So that's about a 10% position there. And then outside of our tactical growth, that growth strategy, we do own some emerging market equity, which is a ticker EEM. And that's, again, for some similar reasons. Improving economy, relatively cheap. The only thing you don't have there is very strong technicals yet. And then you kind of wait around. So you take a little position, maybe 5 or 6% of our portfolio right now, then hopefully that last ingredient, some of those animal spirits start coming in, and then you obviously makes for a good investment.
All right, well, as we look to 2020, what would be your top line advice for investors looking to implement ETFs and ETF portfolios for the long term?
Well, look, the long term, you're great just to buy ETFs and let them hold for 20 years. I mean, it's very difficult as a portfolio manager to say, I can beat that S&P ETF or I can beat that ACWI ETF for the 20-year hold. Why? Well, we have expenses. We're managing for people. So I try to take a step back and say, well, what are you really trying to achieve? And the problem for a lot of people is they might say they have a 20-year time frame, but things change pretty quick when there's a retirement, maybe there's a family emergency, who knows what's going on in their lives, and all of a sudden a 20-year horizon becomes a
short-term result.
You need something right now. So I really love our tactical growth strategy because I think it fits better in people's lives than a buy and hold. Because if you're betting on the S&P the next 20 years, I'll take 8%. I think that's a sound bet because there's not a lot of 20-year periods that doesn't happen. But if you're betting on the next 5 years, what happens if we have a 25 or 35% correction? How does that change your life as an investor? And tactical growth is really spending its time trying to avoid some of those pitfalls that come right now in the next 5 to 10 years. So I like that investment a lot for people trying to grow, but they just can't stomach that 30 or 40% bear market that does come around every 8 or 9 years. So I like that a lot. For people, again, that are just trying to make their portfolio generate some income for them, that's where I like our income approach. Right now, a very short duration. It's about a 4-year duration on our portfolio, yielding 4%. And for people that like it, that's almost a monthly check they can pull right out of their account every 30 days and treat it a lot like a salary payment without taking a lot of additional risk right now.
All right, well, Dan, thanks so much for breaking down these tactical ETF portfolios for us.
Thank you for having me.
All right. And thanks everyone for watching Investing Strategies. Now, that's a wrap on season 1 of our show. Happy holidays and see you in 2020. For Investors Business Daily, I'm Alissa Coram.